Welcome back, everyone, and thank you for watching our video. Today, we're going to start a video series of the basics that you need to know to build your financial foundation. So over the next 12 episodes, we're going to be sharing with you some of the ideas on risk management, insurance, investment returns, wealth building to help you give you enough information about the basics of how the financial world works and how you can apply those ideas for you. So today, we're going to start with basic risk management and understanding the whole story about life insurance. All right. So we're going to start with that today. So I want to welcome my team. Again, thank you guys for being here. Escobar, Terrell, Sonia. I'm so happy to have you on a new topic, on a new video series. So, like I said, today we're going to start talking about the whole story about life insurance. So I would like to start with you, Scoba, today. And I know that a lot of our audience, we're thinking about the market, returns, and there's so many other sexy financial strategies out there. And that we're kind of forgetting about the importance of having old school, vanilla life insurance. So tell us more about why should people have life insurance?
Well, life insurance at its core is about your protection of your assets and protection for your family against the loss of your income due to an early demise. So, but if you look at the building blocks of any type of estate, no matter where you are, you should be able to always list a portion of what you are earning. And the first thing you should put that towards is a mechanism to protect your assets and your family in the event that you end up, the word is, passing away early. One of the first things I always ask a spouse is, in the event that one spouse was passed away, could the other stay in that house, stay in that neighborhood, stay in that school district? And if that answer is no, then life insurance needs to be the first thing that you look to divert your income towards.
Exactly right. And through the years, we have seen the individual ownership of life insurance decrease. There's all kinds of reasons for that. Income inequality, people are not earning as much as before. So life insurance kind of has seen as a additional benefit that people can afford. But another reason for this also has been that the insurance industry has growth in complexity. So now we have all these different products that people can utilize, right? So Escobar, tell us more about what are the products that are available for most people right now when it comes to protecting themselves and protecting their families?
Well, first of all, let me agree with you on the complexity thing. I mean, I am a insurance professional, and even to keep up my own, competence, I have to spend a few hours every month learning more and more about the industry. And there's always something new. So yeah, if I have to keep my focus up, then I think the average individual just can look at it and say, oh, you know what? Forget that, walk away. Give me something simple. Now, to back that statement up, if you just look at whole life at its core, it will fulfill most needs of most families during these times. Now, we can then look at tweaking it and making a few tweaks later on. But at its core, to build up, extra insurance and extra cash value over time without having to get reinsured as a concept should be a part of everybody's portfolio.
So let's talk about that. So in summary, what we're saying is that life insurance at its core is designed to protect and replace your income or your ability to cover any debt you have in the event of dying too soon, right? But also can also be used to transfer your wealth to the next generation if you live beyond your life expectancy, right? So kind of that. And trying to summarize this for you guys, when it comes to life insurance, there's all kinds of types. So it is complex, but we can really summarize it in two options: term insurance on one side and permanent insurance on the other. One of the great benefits of permanent insurance is that permanent insurance creates cash value. So Sonia, tell us a little bit more about what is this cash value? How does that work in the context of insurance? So when we pay premiums, what creates this thing called cash value? What is that?
Well, the cash value is a portion of your premium that is designated as the savings portion. Mm-hmm. So you can use that amount, which will grow, each year for any purpose that you wish, and you can borrow against it. The possibilities are endless. You can use them to supplement your retirement. You can use them to purchase a vehicle or remodel your home. That's a very significant benefit of having whole life.
Yeah, well, we're going to go back to that point. We'll explore more about the benefits of the cash value. But the next question will be, okay, so if I need life insurance, Terrell, how much insurance do I need? How do we calculate the amount of insurance that somebody needs to have? How much is too much? How much is too little?
Question, Jenko. And, usually for each person, it does get specific and individualized, right? But as a nice rule of thumb, we usually try to say for every $50,000 you make, you should have $1 million of coverage. And now what type of coverage that is, that goes down that rabbit hole again as we sit down with each individual and kind of see what fits their best needs and wants for that time period.
Yeah, and for those of you that guys are watching this video and say, well, 50,000, $1 million, where does that come from? Well, the idea here is that insurance replaces your income. So if we were to take that $1 million and put it at 5% somewhere, that would create $50,000 a year, right? If you can only get 3%, it will be $30,000 a year that you replace it. So if you're trying to replace your income, you can use it as a rule of thumb to say, this is how much insurance I should have. So if you are watching this and you say, well, I'm making $100,000 a year and I have $150,000 to my work, well, you're underinsured for the most part, right? And this is not counting your debts and other responsibilities as that. So one of the strategies that are out there, and we mentioned this in our previous, some of our previous videos, but we're going to bring this up again, is this idea of buying term and investing the difference, right? So Sonia, when it comes to the use, exclusively talking about life insurance, mm-hmm. Why is buying term and investing the difference not the best strategy when it comes to protecting you and your family?
Well, people who advocate that really can't show you a track record of people who have bought term and invested the rest. There are a lot of declarations that, your money can earn 8%, but that's not guaranteed. And none of us know anyone who's bought term and invested the rest and thrived as a result of taking that strategy. But we do know examples of people who have bought whole life insurance and have been able to use that money, have been able to tap into the cash value to, put into their business, help their business thrive, help their family with any type of needs that arise. So, yeah, that we've seen. I mean, the track records speak for themselves.
So Sonia, what is the biggest issue that you've seen in your practice with using term insurance to replace income? What has been the biggest challenge you've seen in that scenario? When somebody buys life insurance, just talking about protecting, right? Replacing income. What has been the biggest challenge you've seen in that area?
Usually people just opt for the lowest cost product, mm-hmm. and it's not necessarily pegged to what they truly need. It doesn't adequately cover their income needs, the income needs that their family has for them.
Exactly right. And only goes for so long, right? That's the issue with term that, if you're 36 and you buy 20-year term, that means that you're 56, and what happens to your term, to your life insurance, right?
Right. Yeah, it's very limited.
Yeah, and people should know that only about 1% of all term policies actually pay out. Most policies either drop or they get converted, but they almost never get to the end where they actually pay out a benefit.
True. And that's why insurance companies actually make more, or they have a higher profit margin with term insurance products.
Because they never pay that big number.
Yeah.
Right?
Yeah.
So Terrell, there's another analogy that people use of permanent insurance versus term, which is renting versus owning. Tell us more about that analogy of renting versus owning. What does that mean?
Renting versus owning. Well, that's great. Well, side note but it very relatable is I was reading an article the other day about home owning and people and the life. What's the word I'm looking for? Life, the quality of life, right?
Mm-hmm.
And the quality of life amongst homeowners seemed to be a lot higher than people that rented, and as well as their income at the end of the day. So piggybacking on that idea is, well, when you own something, you actually own it. It's an asset. It's going to continue to create and build value for you in multiple ways. Versus when you're just renting, you're throwing away money that you'll never see again, and there's no long-term gain from it. So you're throwing away money just to keep this possibility, but that's just a possibility. Versus the other one gives you a guarantee. You own it. You can use it for multiple things, and it's a lot more versatile and flexible for the individual need.
Exactly. In other words, when you buy term insurance, you're paying for something, but you're not really building any equity, like you're saying, right? On the other hand, when you get permanent insurance, you're gonna get some equity on that. And as a matter of fact, let me show you guys one quick example. We're summarizing this for time's sake, but we got a 36-year-old individual here who's just gonna buy term insurance and invest the difference, right? And so he's gonna spend close to $127,000 in premiums to be able to have coverage from age 36 all the way to age 86. Now we chose age 89, from age 39 to age 89. So we chose that number because most people's life expectancies nowadays is going to be well into their 80s. So they're going to have that insurance. So you may say, well, but I may want to draw my insurance later. Well, you could do that, but we just want to show you a comparison. So if this person gets just renews term coverage, two things: they gotta be insurable, they gotta stay healthy, and the company needs to be able to offer the product, right? So if those things stay the same, this person is going to spend over $127,000 just in premiums. So here's the $1 million question: how much equity is that person gonna build on those $127,000 over their lifetime? Zero, right? On the other hand, this person can get permanent insurance, which will be a higher premium upfront, no question about that. But the overall outlay is only above $90,000 over their lifetime, because at the age of retirement, we don't need to have any more premiums because we're done with the mortgage. We paid up our contract, right? But at the end of age 89, this person would have developed over $358,000 of equity. So think about that. You go from negative 127 to positive 358. That's a $500,000 swing of opportunity cost just by choosing a different strategy. So when people say permanent insurance is expensive, it's not. It's buying versus renting. Yeah, renting is cheaper than having to pay property taxes and pay for the gardener and pay for the upkeep. But at the end of the day, you will have an asset that you own, that you can control, and you can leverage. So my next question for you, Sonia, is what are some of the benefits? And I know you have a list with you. What are some of the benefits of having this equity, of having this quote unquote cash value that is available to you. We call the no secret of life insurance, in this case, permanent insurance. So give us some of those secrets or benefits of having that equity.
Yeah, I like the way you characterize that, a secret, no secret, because it's information that's available to anyone who's willing to research it, but people aren't inclined to do that. So some of the benefits are that, well, under the current tax laws, there's a tax deferred accumulation of money, and the IRS will not impose any tax on it, but unless there are gains that you earned on that policy. And then also the second thing that people can keep in mind is that their cash value can have a waiver of premium if you become disabled. The insurance company will make the premium payments on your behalf, but you would have to have the rider for that. And then the third benefit is that the cash policy is protected from creditors, provided that you don't commit any fraud, right?
Right.
And then the fourth one is that the policy will help you fund your retirement, and then you can just have it available for you. If you don't want to tap another asset for retirement, you can use your life policy, your cash value policy. So and the other thing is that this policy does have a death benefit. So if you chose to take a reverse mortgage, as a way to generate additional cash flow, you have that option. So
exactly,
it's designed with flexibility in mind.
Exactly. And I know you have a couple more, Terrell, benefits of this equity, of having this equity available through the use of life insurance. So what are those?
Yeah, if I could also join Sonia on the loan and collateral part, you also get the ability that, depending, no matter where you are in your life, you have this death benefit that she's touching on, and also this cash reserve that you could tap into and loan to yourself. And now, instead of paying a financial institution and paying them interest, you get to capitalize on keeping that interest yourself. So not only do you have money you can leverage back to yourself, but you get to also be the benefactor when you pay that money back. So you have multiple ways that the cash is growing and being able to be leveraged. The other big part on this would probably be, at the end of the day, if you stay alive and you get to use all these beautiful benefits that come along with it, but one day it's inevitable that you will die. And when you do die, it will leave your family in a better position, or in the same position, if not better financially, to live out life, to keep up with inflation and handle everything on a tax-free income that they will get from your death with this policy.
Exactly right. And if you guys that are watching this want to know how to use all these benefits and how it works, don't forget to contact us, let us know, and we're happy to show you how that works. But Escobar, I would like to close with you, because I know you've done a lot of research about historical figures, people that in the past have used these kind of tools that we kind of have forgotten about them, but they've been around for a long, long time. So how has people in the past used these structures to build even more wealth for themselves and their families?
Well, first of all, being in California, two names pop up. Walt Disney opened up Disneyland with a loan from his insurance policy. The family that founded Stanford University did that through a policy loan. And a guy named James Cash Penny, as in J.C. Penny, did it. Guy named F.W. Woolworth. I mean, some of the barons of today got their start borrowing from a life insurance company.
Exactly right. So it sounds like that equity has a lot of value that we don't think about it, but it has a tremendous amount of value.
Yeah, and my guess is, especially with someone like Walt Disney, is when he needed a chunk of money to start the park, he did not want a bank telling him things that he should do for his own personal, playground. His happiest place on earth Well, he wanted complete control and how to build it and create it. He was able to do that with the life insurance loan. He may not have had that type of freedom if he went to a bank.
Or if he would have just bought term insurance, right?
Right.
Exactly right. All right, guys. Well, the point of this video is not to give you guys the audience exhaustive, explanation of how all this works. All we wanted to do today is to tell you, you gotta have life insurance coverage. It's extremely important. You gotta make a decision whether you want it to be temporary or you want to be permanent. And we highly encourage you to look at the permanent options because it will provide future equity that will give you a lot of flexibility as part of your financial affairs. So we'll continue this video series. If you want to learn more about how you utilize these tools, do not forget to subscribe. Our email and information is going down below. Feel free to reach out to us, and we're happy to assist you in that quest of you trying to find the best way to set up things for you and your family. And lastly, we actually created a little document, a little PDF manual with all the content of the things that we talked about today. Feel free to download it. It's going to be right down there in the description. It's going to be a summary of all the things that we discussed. Keep it with you, read it, give us some feedback, and hopefully this helps you as you decide to make these kind of decisions either now or in the future. Thank you, team. Thank you for being here today. I really appreciate it, and we'll see you in the next video.
Thank you.
Bye-bye.
Thank you.